Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today I would like to discuss a new market timing strategy. We have quite a lot of them in our database, over 250, so they are really quite popular. It's 20% of the database. Strategy that I would like to describe on our blog, it's called Leveraged ETFs in Low-Volatility Environments. And it's very interesting because it's using the leveraged ETFs such as SPXL, which is directly on daily S&P 500 bull 3 times shares. The leveraged ETFs are very popular by retail traders and also professional traders because they offer leverage exposure to a lot of the different indexes, S&P 500, NASDAQ, etc., etc. And the idea that I would like to describe is inspired by a paper called Volatility Edge, a dual approach for VIX ETNs, written by Carlo Zaratini, Andrew Aziz, and Antonio Mele. So the paper is about using the difference between implied and realized volatility as a signal or a factor that will help you to time the volatility ETFs. And we use that signal as an inspiration, and we are trying not to time the volatility ETFs, but we are trying to time the free pool average ETFs. And why we are using that signal to time the free pool average ETFs?
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
So the reason is simple. The triple average ETFs, they have a problem with the phenomenon known as the volatility drag. What is the volatility drag? So over extended horizons, the compounding of daily returns causes realized performance have to be different substantially from the theoretical free pool return of the index. So when you have the high volatility, the higher volatility tends to accelerate this erosion. The triple average products are interesting when you want to trade them for a short period, but if you like to hold them for a longer period of the time, you have a problem because you are losing the money to that volatility drag. Volatility drag means that when the ETF tries to have the constant leverage 3-to-1 on a daily basis, it basically has to buy high and sell low. When the market is rallying intraday, the ETF must buy the underlying over the day, and when the market changes and goes back down, it must sell for a loss. This is especially a problem when there is a high volatility, and over that high volatility, the volatility drag is higher. So what is our idea is that we will try to use the signal that is proposed in the paper, Volatility Edge, to time not volatility ETFs but free pool average ETFs. So we will try to reduce the exposure in high volatility periods and maintain the exposure in the calmer markets. So to have the leverage effectively and mitigating the most damaging drawdowns and the problem with the volatility drag. So that's the idea. What's the methodology? So we obtained the data from January 2013 until July 2025. So we have around 12-13 years of the data that we can have. Here is the performance of SPI, and we can use that SPI performance as a benchmark. So we can see that the SPI had a performance over 13%, which is absolutely a great performance and great 13 years for S&P 500. Standard deviation 17%, maximum drawdown -43. So we have Sharpe ratio 0.79 and Kalman ratio 0.4. So this is our benchmark, and we are trying to have the better performance with the market timing strategy built for triple average ETFs. What is the idea? We have a short-term realized volatility that can be calculated as the annualized standard deviation of SPI returns over the recent days, 5, 10 or 20. And then we have an implied volatility. Implied volatility can be represented by VIX, which is our implied volatility index. I mean, everybody knows this index probably. It's a fear index, sometimes also called. And we will try to compare the realized and implied volatility. And if the realized volatility is lower than the implied, it means that we are in a calm period. But once the realized volatility jumps over the moving average or smoothed VIX, we know that we are entering the high volatility period, and in the time it's better to not have the triple average ETF exposure. So we will try to get out of that position. So the comparison between those variables determines whether to invest or not to invest in leverage ETFs. That's the idea. Here we have the SPXL, so which is the triple average ETF. So we have a performance. We can see that the performance is significantly better than the performance of SPI, but also the risk is significantly higher. So the maximum drawdown is more than 2 times higher, and standard deviation is 3 times higher. So we have a smaller Sharpe ratio and smaller Kalman ratio than just holding the SPI. Of course, we have a higher performance, but I mean, we have a problem with the drawdown, and a significant problem. Because I mean, here, if the SPI had the drawdown -33% over the last 14 years, we know that the SPI can have a easily drawdown over 50%. So in case in the future there will be a drawdown like 50% in SPI, so we have once again, the problem like in 2000 or 2008, the triple average ETF will have a drawdown of like 90%. It's a real problem, and it's not as simple. What we can do is we can use our market timing approach. So we can compare the short-term realized volatility with implied volatility measured by the VIX index. And if the VIX index is higher, it indicates that the market expects large moves in the future, and the investors are overpaying for insurance, and in this case it doesn't make sense to hold triple average position. Okay, once again here we have both of the benchmarks, and let's take a look on the strategy. The strategy has two parameters. So the first parameter is the moving average of the VIX. This is the basic strategy. So the basic strategy is that if the SPI's 10-day annualized standard deviation is lower than the 60-day moving average of the VIX, we are in the market. And if SPI's 10-day annualized standard deviation is higher than the 60-day moving average of the VIX, we are out of the market. And those two parameters, so 60-day moving average and 10-day standard deviation, were suggested in the paper. So I mean in this paper. Here we have the performance of the SPXL basic strategy, and here we have a benchmark SPI. So what we can see is that the basic strategy from the paper without any change, so using the same trigger, just not using the volatility ETFs but triple average ETFs, increase the performance. We have a higher drawdown, a higher standard deviation, but I mean the same Sharpe ratio and better Kalmar ratio, but we will try to improve that measures. So one of the ways how to improve the measures is to check the robustness. We have two parameters, and we would like to check whether the strategy performs well, not just with using the 10-day standard deviation, but also 5-day and 20-day standard deviation. So we will change the standard deviation calculation, and we will check what is the performance and what are the Sharpe ratios and Kalmar ratios. So here we can see if you move the 10-day standard deviation to 20 days, so I mean if you use the longer period for calculating the realized volatility, our performance is even better. So we have even better performance, lower drawdown, same standard deviation, so we have a better Sharpe ratio, better Kalmar ratio, and we are easily beating the benchmark. So holding just the SPI, we have 2.5 times better performance with a little higher drawdown, but I mean just a little, 2 times higher standard deviation. So I mean from that we have significantly better Sharpe ratio and Kalmar ratio. But we do not need to change only the calculation period for the realized volatility, but we can change also the moving average or smoothing parameter for calculation of the implied volatility. So for the implied volatility, the basic measure is 60 days. I mean this is what is suggested in the paper, and we can change that to 10, 20, 30, 40, 60, 80 or 120 days. So I mean we will check multiple parameters and we will check what will be the performance. So once again, for the moving average or for the smoothing parameter of the implied volatility, the shorter time frames are the better. So I mean instead of using 60-day moving average of the VIX, it's better to use just the 10-day moving average of the VIX. Once again, the performance is over 2.5 times better. Maximum drawdown is slightly higher, but just 10% higher. Standard deviation approximately 2 times bigger. The Sharpe ratio is better, and Kalmar ratio is 2 times higher than the Kalmar ratio of the index itself, so our benchmark. What does it mean is that we can very easily change the parameters, and the strategy is robust. It is not very important what parameters will we use, so it's better to have the shorter window for calculation of the average of the VIX, so the smoothing of the VIX, and have a little longer window for the calculation of the realized volatility. But I mean all of the parameters are better and they are easily beating the benchmark on the Kalmar ratio, and a lot of them are beating the benchmark on the Sharpe ratio. Here in this case 3 of the parameters are beating the benchmark on the Sharpe ratio, and 2 more have the same Sharpe ratio, and I mean all of the parameters are beating the benchmark of the Kalmar ratio. I would say that the strategy is really robust. Then we tried another thing, so we tried to come up with triple leverage strategy, but in this case the strategy that is shorting the S&P 500, and in this case we were looking for the strategy that can work as a crisis hedge. So here we have the SPXU ETF, which has a really awful performance because it has the minus 23% per year performance, so it's losing the money, which is logical because the market was going up 14% per year, and if you short that market and you have a triple leverage and you are losing a lot of the money over the year. But what are the advantages? As you can see, there are quite a lot of spikes at the time when the market is in the correction, so we will try to time those spikes. And how we can try to time those spikes? So we can reverse the trading strategy rules. So in case the realized volatility is higher than implied volatility, so if the SPI standard deviation is higher then a 60-day moving average of the VIX, we will enter the triple average short ETF. What is the important is that, we still have the negative performance, minus 8%, but it's not minus 23%. So the price that we pay for the hedge in this case, I mean, if we use the systematic strategy, is significantly lower than just using the SPXU, the triple average ETF, all of the time. So here we can see that all of the spikes in our hedging strategy are at the time when the benchmark, so SPI, has a negative performance. So I mean, if you mix those two equity curves together, so the red one and the blue one, there is a high probability they will have a better Sharpe ratio, better performance than just holding the benchmark itself. So this is one idea, and here we tried even to change some of the parameters. If we change the parameters and we move the windows over which we calculate realized volatility, the cost for hedging is even lower. So I mean, this is very, very nice. So the best is to have the very short window for the calculation of the past realized volatility. If we use just the 5-day window, we have even positive performance in a hedging strategy, which is quite surprising. Then we try to change the moving average from 10-day to 120 days. And here once again we can see that there are some of the windows over which there is a significantly shorter or better performance. So I mean, we still have the negative performance, but the cost is not so high, so we can play with that also. We were not moving more into these areas. We are not trying to build the hedging strategy. In this article we mainly try to build the strategy to time the long side of the triple average ETFs. Why it is so? Because in the future we are preparing the article in which we will come up with a better hedging strategy, the strategy that uses the long volatility ETFs, which are even better for the hedging purposes than triple average short ETFs. You can look forward to it in the next 2 or 3 or 4 weeks. We will have a video about how to build a long volatility hedging strategy. So thank you very much, and I hope that you liked this video and you will join me in the next one. Do not forget to subscribe to our channel or buy the Quantpedia subscription if you would like to see more strategies. So thank you very much.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.